We continue our discussion of the Dutch dividend stripping Supreme Court case because there are still quite a number of interesting aspects to look at. First, as mentioned, the taxpayer argued that it might have a PE in the UK, and under the court decision it said at the hearing of the court on 2 July, the taxpayer stated that it has a permanent establishment in the UK and that almost all of its profits must be attributed to the permanent establishment. In the opinion of the court, the taxpayer, this is the High Court, did not demonstrate sufficient grounds to lead to the conclusion that the persons who performed worked for it in the UK did not act within the normal course of their business. In other words, we're talking 5/6. If you're in the normal course of your business, you don't have an agency PE. So this is what the taxpayer argued. I have a PE, and it's a PE that holds the shares, and it's a PE that made the share certificate deposits with the custodian. The Supreme Court then goes on to discuss the High Court case, and it says, as set out in 341, the court finds that the burden of proof rests with the taxpayer to demonstrate facts that show that persons who worked for it in the UK do not act as independent representatives acting in the normal course of the business. So the court says that, it's the High Court that claimed, and it's and the taxpayer needs to prove that this was not a 5/6 PE. And the Supreme Court turns this around. It says the judgment of the court shows an incorrect interpretation of the law, because the interpretation of the law generally is he that makes a statement has the burden of proof of that statement. The inspector invoked the effect of Article 5/6 of the treaty, in other words, the independent agent PE. The taxpayer, therefore, does not bear the burden of proof referred to in Article 5/6. To that extent, the taxpayer's appeal succeeds, because the taxpayer said to the Supreme Court, why should we prove that this is an independent agent PE? It's a dependent agent PE. It's a taxpayer, it's a tax inspector that says that it is a independent agent PE. Now, I have a couple of comments, and it's very interesting to explore the consequences of these statements. A 10-second commercial. If you want to learn more about international taxation or transfer pricing, or treat yourself to an all-round update, or if you want your team to learn or stay updated, please visit my online courses. The first one is that it is the Supreme Court that made a mistake, because the taxpayer argued first that there was a PE. And then the tax inspector argued, yes, but if there is a PE, it's an independent agent PE. Now, whoever makes the first statement needs to provide the proof. So the burden of proof is on the taxpayer to prove that it did have a PE before you even come to the discussion of whether this PE was an independent or a dependent agent PE, right? Because it is the taxpayer that makes the claim. And I think the taxpayer have a problem, because the court can just say, well, if you believe you have a PE, show us your 2009 to 2013, that's the years involved here, UK PE tax returns, because if you believe that you have a PE, then I'm sure that you have filed PE tax returns, and it'll be kind of embarrassing if they didn't. And then second, since the taxpayer has no FTEs in the Netherlands, if it does have a PE, then all its income will be allocated to the PE, right, and in the UK PE. And therefore, it'll create some interesting consequences. Now, if we look at Dutch dividend withholding tax, that will still be due, no matter whether there's a PE or now. But now it will not be the Netherlands that needs to give a credit for the Dutch dividend withholding tax. It will be the UK, because there's a UK PE to which this income is allocated, upon which the Dutch dividend withholding tax is levied. Now, you have an interesting discussion, right? You've got a Dutch company with a UK PE holding shares in a Dutch company. How does that work in terms of Article 10, and how does that work in terms of Article 23? And there's some interesting guidance in the OECD commentaries to Article 23, which I don't think is widely read, but here it is. OECD commentary 2017 to Article 23, and then paragraph 9. Where a resident of the Netherlands, and I've changed the wording here to fit the text, derives income from the Netherlands, which happens here, through a PE which he has in the UK may tax such income if it is attributable to the PE. Common sense, right? The Netherlands must give relief under Article 23A and B for income attributable to the UK, notwithstanding the fact that the income originally arises in the Netherlands. Now it looks like there's no withholding tax due, right? But then the commentary goes on to say, however, where the contracting states agree to give the Netherlands a limited right to tax as the state of source of dividends, as the UK and the Netherlands have done in Article 10.2, within the limits fixed in Article 10.2, then the two states should also agree upon a credit to be given by the UK for the tax levied by the Netherlands, along with the lines of Article 23A2 or B1. And so here you see that even though there is a UK PE of a Dutch company and the income is allocated to the PE so the UK can tax, that does not mean that the Netherlands cannot tax dividend withholding tax on the income of Dutch companies going to the UK PE. So the right of taxation of the Netherlands remain. I think another interesting issue to discuss is the profit allocation to the PE, and transfer pricing in general has been under-highlighted in this case. So let's look at some comments on possible consequences. First, since there are no FTEs in the Netherlands, because the case say they only had a board in the Netherlands but no FTEs because all the significant functions were assumed in the UK, that means that also the risk was controlled in the UK, right? And this has a number of consequences. First of all, the assets, which are the AEX shares, the collateral in US dollars that it gets, etc., must be allocated to the PE. But there is a funny rule in Holland which says that if you have a PE in another country, even though the other country can tax that PE in its currency, you as the Netherlands are still allowed to tax the currency movements on the equity of the PE from euros to whatever other currency the PE has. So let's say the equity that the PE we pretend had an equity of 1.2 billion or 2 billion. You'll see why I say that in a moment. Whatever currency movements there were between the UK and the euro during this time would remain taxable in the Netherlands, because that currency movement is not taxable in the UK because the UK taxes in pounds, not in euros. So therefore the euro pound currency fluctuations belong to the Dutch head office. And if you look at the period here of the pound to Europe movements from 9 through 13, you can see there were a lot of fluctuations, right? And these will become taxable in the Netherlands. You also have to bear in mind it's not only the fact that you look at the whole period, but there were these share loan transactions back and forth every time, and also the redemption of the USD collateral back and forth every quarter. And all of those would be triggering moments because all of those are capital gain or capital loss realization moments, to the extent that the movements are not fully hedged, right? Because if it's fully hedged, then you don't have to realize the gains, but you also cannot realize the losses because the losses are hedged. And if we look at the US dollar movement to euros during this time, you can see they were not exactly the same as the pound movements. And I'm not sure whether these charts are flipped or not. It might be that the one is euro to GBP and then USD to euro, which might mean that they should be mirroring each other, but still the movements are not exactly the same. So the taxpayer, this PE argument triggers some interesting Dutch HQ calculations. I want to go a little further on TP, and now let's ignore the UK PE and we just look at the base case, right? Comments on possible consequences. What were the transactions? If we look at the transactions very high level, because we're going to look at them more in detail in a moment, share lending, collateral, and management of everything involved, right? But all of that happened in the UK. What does the Netherlands local file say on functions, assets, and risk? Because there must be a local TP file. There are intercompany transactions, and if regardless of PE or no PE, the UK performed all these functions for whom all the transactions were recorded in the Netherlands. And even though we talk about intangibles, these may not be intangibles for which article, paragraph, chapter 6 of the OECD guidelines apply, but still the principles of chapter 6 do apply. He who does the work and he who takes the decision should bear the risk and should be compensated for what he does. So first of all, as all functions are performed and risk is controlled by the UK parent, and the Netherlands taxpayer is by definition low risk because it has no one to manage the risk, should the UK parent compensate the Netherlands for this tax assessment as part of the transactional risk wholly controlled by the UK parent? Now, if you think this through, if the UK takes care of all the affairs of the Netherlands, including risk assessment, that risk control would also include tax risk, and surely the Dutch dividend withholding tax and its credibility must have been one of the major risks flagged in this transaction, and we'll see a little bit later why there's more reasons for that. The second question from a procedural point of view is, did the Dutch tax authority look at the Dutch taxpayers' TP files? Should the High Court have looked at it? And if not, why not? Because it says something about how the taxpayer thinks about its own position, right? And along those lines, should the positions taken by the taxpayer in its TP file be taken as the truth for the taxpayer, e.g. on whether it had a UK PE or not? Because if it doesn't say that in its PE, in its TP files, why would we believe it? If it didn't say it carried any risk, why should it get the income, etc., etc., right? And if we should not look at the TP files, should we then say, well, okay, you had a PE or you did whatever, and your TP file is not in line with what you argue now for income tax purposes? That means your TP file is simply not complete. And should you be penalized for that? I think there would be a lot of issues to discuss here. And then finally, I want to look at the numbers and the check the box rules, because there are a lot more here just to consider for us. I'm going to quickly go through the setup as it was described in the High Court of Amsterdam of what was going on. Step 1, the funding of Y Limited. Now, Y Limited was the intermediate holding company and capitalization of XPV as we see it here below. And the steps were Z Limited, that's the UK parent, will lend 5.4 billion to Y Limited, which is a check-the-box subsidiary of Z Limited, right? So we have a hybrid entity here, and there is our loan. Y Limited will capitalize XPV with 1.2 billion of ordinary share capital. XPV is a check-the-box subsidiary of Z Limited. I assume that when they say check the box, they mean that the box was checked so that these entities are seen as tax transparent. The day-to-day operational activity of XPV is run by employees of Z Limited. Now we know all of that already, right? But so here we have the 1.2 billion, and then Y Limited will lend XPV 4.2 billion on normal treasury intercompany loans. So they'd use the 5.4 billion for 4.2 billion loan down and 1.2 billion capital contribution. Now remember, these were the initial amounts, and the total amount of investments in AEX shares ballooned up to, I believe, almost 8 billion at some point, right? Step 2, building the arbitrage positions. And here things get interesting. XPV will purchase 5.4 billion AEX stock. We've already seen that, and that could grow up to 7 billion. XPV will enter into a 5.4 billion notional short near expiry AEX single stock futures. So XPV also sold futures to the market because it had the shares to cover it. And while it was selling the shares to the market, it also went and made a stock loan to Z, or the UK parent, as we've seen before, right? And the stock loan was then covered by a USD collateral of 5.4 billion, as we have discussed before. Now, any surplus cash that XPV had was then lent to Y Limited to pay down the loan with Z Limited, right? So you saw a loan going here, and this is interesting. I don't know why you would lend the money to Y Limited if you still have a 4.2 billion loan to Y Limited. Why would you simply redeem the loan? But maybe that's because the loan from Y to X was long-term and these were short-term loans. And then Y would use this extra cash to redeem the loan with Z. Again, Y could have used that cash when X was paying down its loan to Y. I'm not quite sure what the mechanics behind that is for not redeeming this. And then XPV entered into swap to convert US capital to funding balances to euro to cover its currency risk, I assume, and then it will pay some margin fees to the banks. But also just remember that we said that Y and X will be hybrid. So let us look at some numbers to illustrate a couple of points. If we look at possible calculations, again, I've got no idea whether these numbers are correct or not. I'm pretty sure they are not, also not even proportionately. But XPV had 1,000 dividends that it got from the stock that it lent to Z, which then Z had to pay on to XPV. It got, let's say, another 1,000 on lending the shares. It earned 500 on futures. And then it paid 1,000 to Y on this $4.2 billion loan. So its taxable income was 1,500. We'll assume that the Dutch corporate income tax is 25%, and then X would have paid 375, but it got this 250 dividend withholding tax, which is the 25% of the 1,000 that we saw above, and that the whole litigation case is about. So it owed in the end a tax of 125. Now, if we look at Y Limited, that would be a lot less, right? Y Limited is an intermediate holding company. It earns the 1,000 that X paid to it in interest income on the $4.2 billion loan. It then has to pay interest to Z, the parent, and it has a $5.4 billion loan, so it pays, let's say, 1,100, and it makes a loss of 100. And the court talks about that this loss is being surrendered to the parent under UK law. So if we look at parent, or Z Limited, first of all, it has dividends which it receives on these AEX shares of 1,000, but it has to pay those dividends to XPV, so it's got zero income there. Then it has interest from Y Limited, the 1,100, on this $5.4 billion loan. Let's say it owes X another 1,000 on the stock lending, and it has other income of 1,000. So its total income before tax is 1,100. Then it gets 100 in loss surrendering from Y, so its adjusted earnings before tax is 1,000. I'm not sure what the UK terminology for this is, but that's what the numbers come down to. We'll assume that there's also 25% tax in the UK, so that's 250. And now the interesting question is, does Z also claim the Dutch dividend withholding tax credit, right? So is this withholding tax credit being claimed twice? And you've got to think this one through, because does it matter if the UK uses a credit system that Z claims the Dutch dividend withholding tax credit? And the answer is it shouldn't, right? Because if the income is taxed twice, the credit should be claimed twice. You're not double dipping or anything here. Things go wrong if Z claims that dividend withholding tax credit twice. So for instance, it first claims it when it calculates the income of X in its normal affairs as an underlying tax, and then on top of that, it also goes and claims the withholding tax as a withholding tax held on the stock that it lent, right? You should not do that, because then the withholding tax gets claimed 3 times in total, not twice. One needs to think this one through. And then remember, UK Holdco is hybrid and the Dutch taxpayer is hybrid. So let's just end with looking at this picture from a US point of view. And it will look very simple. There's no UK intermediate parent, so there can be no loans to the UK intermediate parent. There is no XBV, so there can be no loans to XBV. All the shares that XBV held from a US point of view are deemed to be held directly by Z. It is Z that sells the futures on the Dutch stock exchange, and it is Z that pays the Dutch dividend withholding tax. And now you get the same issue here. Is the Dutch dividend withholding tax creditable in the US, regardless of whether it actually ends up being levied or paid by the UK parent or by the Dutch BV? And the same issue applies again. If the income is taxed twice or 3 times, once in Holland, once in the UK, and once in the US, then the credit should be claimed 3 times. But I think what will be interesting to see is what happens if the Netherlands doesn't get the credit. Does that mean that the effective tax rate in the Netherlands become higher, and therefore both the UK and the US must give larger credits for the underlying income tax of the Netherlands / the UK from the US point of view? Or does something go wrong there? I don't know. There are so many assumptions here that these are bound to be wrong, but I think these are interesting questions to go through in this case, which have not been discussed in court. I hope you enjoyed this case. I know it's been a long discussion, but I think it is warranted if we look at all the other issues surrounding what we only read in the court. I look forward to seeing you next week. Bye for now.